Hey guys, Mr. Fired Up Wealth here, aka Eric. I wanted to bring a video here about the rebalancing of portfolios. It was actually a request from our private Facebook group, the Fired Up Wealth private Facebook group. We had a poll. I'm also going to reveal my top 20 holdings and discuss how I actually balance my portfolio. So stay tuned. So here is what I was referring to. We have a group on Facebook called Fired Up Wealth, and we had a poll that ran from August 21st till about a couple days ago. And I blocked out some of the names here just to respect privacy, but you can see the very top had 10 total votes, and that was manage each stock weight in portfolio, example percentages by max position, as well as portfolio rebalancing tips. A friend of mine, Gustavo, shout out to him. Appreciate everybody else's responses in there as well. Ann, who's a great contributor, and several others. So jumping right into it. So what is rebalancing? The next slide will kind of cover that, but let's just speak, without going through fancy terminology. Rebalancing basically is just buying and selling assets to get to a particular percentage that you want in your portfolio. In order to get to that, you need to have a plan, and we'll get to that in a minute. But you have to have a plan and know what you're trying to accomplish within your portfolio before you can actually determine what percentages you want, and then try to stick to that plan and stick to a method in order to rebalance and stay on track, stay on target. So what is portfolio rebalancing? It is the process of realigning the weightings or positions in a portfolio of assets. And typically here we're speaking about obviously a stock portfolio. This could be other things as well. It could be, real estate. It can include lots of other things, but most people listening are interested in stocks, ETFs, bonds, your basic, financial portfolio that you would have with a brokerage account or an IRA or what have you. So typically periodic buying and selling of assets to maintain original or desired level of asset allocation or risk. For example, say you wanted 50% and 50% bonds in your portfolio, and you had that for a year or two, and now all of a sudden your stocks have outperformed your bonds and your stocks now weigh 70%. If you still wanted to have that 50-50, of course you need to sell some of those stocks and buy some more bonds to rebalance your allocation. The tricky part is how to allocate individual stocks, and I'm going to talk in a little bit here about how I actually do it within my stock bucket. And as I mentioned earlier, first you need an overall investing plan, and then you need to figure out a rebalancing method. So there are two methods for portfolio rebalancing, and you need to decide which one's best for you. The first is periodic rebalancing, and this is basically something that requires little effort other than the fact that you need to do it, and you set up a preset time interval, maybe quarterly, maybe bi-yearly, maybe once a year, what have you. And you need to set a reminder. Some people do it when they file their taxes at the end of the year. Some people, if they're self-employed, they might do it quarterly when they pay their quarterly taxes. It can be whatever you decide is best for you. The second method is tolerance rebalancing. This is what I use, and it's a method that will help you rebalance your portfolio to align intended asset allocation, but it's based on percentages. And it's really better for the more actively managed portfolios. So if you're not someone who likes to manage your portfolio and spend a lot of time on it, you probably should look at number one, the periodic rebalancing. Most people watching this video are probably a little bit more active, some more than others. But that tolerance rebalancing, I think, is very key for outperformance. It's served me very well. There's a simple approach, and that's the percentage that we mentioned earlier of stocks versus bonds. But then there's the advanced approach when you look at it under a microscope of what percentage of each individual stock within that stock bucket. So if you're at 70% stocks and 30% bonds, how the heck do I allocate the 70% worth of stocks if I'm using individual stocks? That can be tricky. I'll tell you what I do here in a minute. During volatile markets like we have right now, this approach, of course, carries much more risk and is more expensive. Why? Because you're constantly buying and selling, and you're paying $5 or $7 or whatever your broker charges you every time you buy and sell shares. So it can really eat into your account, especially if you have a smaller account. The method will likely change as you age and your portfolio grows, and I'll get to how mine changes as I grow here in a minute, and it'll make more sense. So what do I do? My current plan, and this is only for my taxable stock portfolio. So I also have, IRA and I have 401k, which is very different how I manage those. The majority of my assets, though, are in a taxable account. Of course, if you're in the fire approach, if you're trying to retire before 65 or 60, in your 60s in general, it's a lot easier if you have a taxable account because there's no restrictions or ramifications or penalties for taking that money out early. It's yours. Obviously, there's tax ramifications, but there are benefits, pros and cons to everything. So my plan is 80% individual stocks. That's a combination of both growth stocks as well as DGI stocks. So growth stocks like an Amazon, and DGI like it could be a Microsoft or a Visa or what have you. Right now it's 15% allocation is core position ETFs. I like the triple Qs, ITOT, which is iShares Total Market Index, as well as DGROW, which is another iShares Dividend Growth ETF, and then IVV, which is the iShares equivalent to the S&P 500. If you're with Fidelity, all the last three, the ITOT, the DGROW, and the IVV, those are all commission free to buy. The Qs are not commission free through Fidelity. It costs $4.95 per purchase. I like to carry a 5% cash minimum, and this varies as I trim, as I sell profits. It can range between 5 and 10%. I like to keep a minimum of 5% in case of a big pullback. In long term, the goal is 50% ETFs and 50% individual stocks of dividend growth investing. That DGI means dividend growth investing for those that don't know. And so each year I do adjust percentages to get to that end goal. So my strategy takes a little bit more effort, and each year it does change a little bit. Obviously, you need to decide what's best for you and adjust accordingly. So with this, out of my 80% bucket of individual stocks, which includes growth and DGI, the individual stocks in that bucket, I generally keep between 1 to 3%. Okay. So, obviously it depends on the size of your account, and that strategy can be different for each person. But let's just say you have, for simplicity's sake, let's say you have $1 million account. Okay. So 1% of $1 million, of course, is 10,000. So in individual stock, you'd have between $10,000 and $30,000 in $1 million account to get that 1 to 3% individual stock allocation. Here are my top 20 holdings out of 107 total holdings as of today, September 4th, 2019. So I keep 1 to 3% max holdings. You can see on the right, Amazon is my largest holding. QQQ, which is ETF, is my second. Now the ETFs are a little different because I said that 15%, of my total portfolio is ETFs. So that QQQ there doesn't have to be 1 to 3%. It just has to be within a 15%. So I actually have 5 different ETFs, and I have 3% for each on average. The Qs might be slightly higher. Obviously a technology ETF. And then you see Microsoft, Oracle. Now the Oracle, I've sold a ton of that, but most of that is from when I worked at Oracle, and it was purchased very cheap. I believe in the teens, $12, et cetera, per share. So I've sold a lot of that as I've aged, but I still do have about a 3% position in Oracle. And if it ever gets back into the 60s, I'll probably sell more of that. But you got to be careful with the taxes. With something like that, those are huge multi-bag type holdings. And when you sell, it's long-term capital gains, but I'm at a 20% long-term capital gain. And that does, it breaks the rule that you can't be afraid to sell and pay the tax man. But at the same time, you have to be smart about when you do it. And so a stock like Oracle, it's good DGI, it pays a solid dividend. And in a few years, as you decide to roll into more of a different role and say your income lowers, now you could actually sell and be at the 15% mark instead of 20. And so, each person is going to have their own strategy and their goals. And like I said, I've sold a ton of Oracle. I still have some. You can see all the different ones there. I'm not going to read them all, but a lot of that's tech heavy. And you can look at that and say, well, how did this perform? Well, what you don't see is the other 80, some holdings, 80 plus holdings. And most of those are the 1 to 2% range. And there's some crazy high risk stuff in there. Like when I bought the Aurora cannabis at $1.50 and sold it at, $11.50, or, Fastly, which is up 100% in 2 weeks. You don't see all of those. Maybe someday we'll get to that point, but, really that is what drives my growth, is those 1 to 2% holdings. Almost none of those are DGI in those smaller buckets. There are some, but the ones that are really growing. So you can see 26.14% is the 1-year investment return on this portfolio versus, the S&P 500 index at 7.99%. So, obviously it's outperformed pretty significantly over the past several years, and it's done well. This strategy does take a little bit additional time and effort in management, but you can see that the results for me at least have paid off. This is only recommended for larger accounts. So if you have a smaller account, I would adjust the percentages to maybe 3 to 5%. So when I say larger account, typically, that's going to vary per person, but just to give you an idea of scale, it's 7 digits plus. You're going to be at that 1 to 3% max holding, back to that 10 to 30,000 that we talked about earlier. If you have a $5,000 account, that's okay. Trust me, I started. It's a little bit of my history. For those that haven't watched the channel, I grew up a single parent home. My mom worked her butt off, but we didn't make a lot of money, and I didn't come from wealth or anything like that. I started real young saving. I've always worked hard, been kind of an entrepreneur. Worked hard to make my own money, and I tried to save at a young age. Started at $50 a month in my early 20s, and I started even investing before that when I was a teenager, and then slowly that grew as my income grew, as my knowledge grew, as I made mistakes and failed, and decided I learned what was right and wrong. My investment strategy changed. My savings amount changed. My disposable income changed. And that grew over time into a large account over 20 years of grinding and investing. So the end game, so each stock has an allocation assigned, like I mentioned, and I manage those by shaving profits. So if Amazon goes to 2,500, which is the target, now I'm going to be way over my my 3% allocation. And if I get to 4.5%, I shave it back down to 3. Okay, so now I shave Amazon back down. I take those profits and then I buy DGI stocks. If it's a DGI stock that runs, like when Oracle, I just sold $25,000 or so of Oracle not long ago. I bought, BMY. I bought a little bit of MO. I bought some Tyson. Those kind of DGI stocks would have some good growth, but also dividend growth. And at the end game, it's all DGI. And between ETFs and individual stocks, live off dividends and never liquidate accounts. So you might have to sell if the story changes, but you're not having to use a 4% rule and delete that or dwindle that account down to zero. That account should continue to grow, not as much without the dividends being dripped in, but it'll continue to grow, and it'll give me options at older age. If I need to sell some for emergency, I can. If I don't, great. Then my kids inherit the extra money, and they've got a nice little start to life that I didn't have. So that is it, guys. That is the strategy. That is the plan. That is how I basically rebalance my assets. And each person is going to be different depending on their strategy. But hopefully this helped you at least give you some ideas so that you can utilize some of this information in your own strategy and approach within your portfolio. If you haven't subscribed to the channel, please do. Bottom right corner, hit the subscribe button. There's a little bell. Hit the bell. I hope you like this. If you do, give me a like, throw a comment out. Hope to see you guys around. Appreciate you listening and watching this video. Have a great rest of your day.